Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Tuesday, September 5th, 4:43 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend since 8:29 when we had an O'Neill follow-through day. Check over here in the trend gauge. We've got leadership on green. Downgrade today, however, as two of the five major indexes had harsh breaks back below their short-term 21-day moving average and their medium-term 50-day moving average, that being the mid-cap and small-cap, as interest rates and the dollar were both higher today. And these stocks bore the brunt of the negativity, really underperforming today. You'll see the charts when we get to them. All five of the major indexes still above the 200-day moving average. We break this down into three time frames because we invest over three time frames. We've got how the moving averages are of the five major indexes and how our market leading stocks acting up. This dictates how much exposure we have to the indexes or to the market. So what happened today? Big oil gapped up this morning as Saudi Arabia and Russia reinforced production cuts and pulled off a little bit as it got extended. We'll take a look at this on the chart segment today. We're going to look at all of the holdings in GROTECTION against Keltner channel, so you'll see how extended they are from their 21-day exponential moving average. And the big seven, a couple of them red, but for the most part, this is what kept the overall numbers from being worse than they were certainly on the big cap indexes, because as I said, yields popped in addition to oil, and the US dollar was strong today. Small and mid caps taking it on the chin. Here are the final numbers on the day. RG8, this is our 8 growth ETF composite, down 1.24%. S&P 500 late in the afternoon fought trying to get to flat on the day, but sold off late, down 0.4%. NASDAQ 100, the lone bright spot, and that being just barely up 0.13%. Dow down 0.5%. Mid caps down 2.3. Small caps down 2.1. Global diversified 60/40 stock bond down 0.58%. Duplicate returns for both world stock and world bond today, both down 0.58%. In-house GROTECTION down, but only 0.16%. We got some outperformance by Tesla, which bounced back nicely relative to it being down on Friday, and also NRGU and our TBT position, which goes up as interest rates go up. So those helped us out in the right direction today. As I said, we'll go through all the holdings when we get to the Keltner charts. Let's get to the charts, and then our inter-asset correlation charts, and then we'll get to the tail of the tape, and then we'll get to the thinkorswim charts. Start off with the S&P 500. So really what you can see here is where we are is 4 straight up days after putting in a shakeout. This was on 8/24. Tried to challenge 50-day moving average, failed. 4 up days, and now 3 days of a consolidation, very tight range. Coiling for a move. The question is, will that move be higher or will that move be lower? And that depends on how you determine what type of trend we're actually in. But you'll see the 8, the 21, and the 50-day moving average all coiling up here right below price. That typically, and I say typically, there are no absolutes in the market, but that should provide a level of support as the indexes pull back. My expectation is that we would bounce there. If we break there, I've talked about that 4,300 to 4,330 7-layer burrito of support. That's the next level down here. Bulls and bears have both been claiming seasonality on Twitter is in their favor, as September is typically a weak month, but September after you're up is typically up on the year 15% or something like that. I think I saw the metric was is typically strong, but seasonality is normally strong the first part of September, weak the last part of September, and the first week in October before a rally into year end. We don't predict. We're aware of these things. They're secondary indicators. We track price and volume of the indexes and let that be our guide, not some rote rule on this, that, or the other. So let's go to the NASDAQ 100. You can see still above all three of the moving averages, but they're tightening up. We like to see that, and we're expecting them to provide support on any further pullback. For here, you see, again, the 5 days up and 2-day consolidation for the NASDAQ as it has been showing. You can see the relative strength here. NASDAQ leads up, and it also leads down. Let's go to the Dow. Dow actually was the lone big cap, and this was late to break below the 21 and the 50-day moving average. So if I was counting on that confluence of moving averages to cushion the Dow, I didn't get it. But the Dow is really at the mercy of a couple of high-priced stocks that are it's kind of top heavy. But yeah, the Dow did break those moving averages today, and we'll see what tomorrow brings. So that just leaves the S&P and the NASDAQ above their 50 and 21-day moving average. This is what I didn't like to see, and that's a big bar compared to what we saw on the 6 days up for mid cap. So 6 days up, you're expecting a pullback. Yeah, this isn't the type of pullback you wanted to get, though, where you're down 2.3%. There was nowhere to hide whether it was growth or value. Mid caps just took it on the chin today. And small cap, same situation. Again, look at that big bar compared to, well, this one's not quite as dramatic relative to the size of the other bars as we took the way up, but still 5 out of 6 days up, and then a reversal undoing the last 4 days, 3.5 days worth of gains, closing below the moving averages. Not what we want to see. We'll see what tomorrow brings, though. Let's check the VIX. VIX is oversold, and it bounced today from this very low level, which is around the 13 level, which has been a support level. So VIX up, index is down, and you did see that. We got to pay attention to this. We've got moving averages overhead. Breaking above that 15 level and the 21 will, we would expect some pressure to be on the indexes if that happens. Let's check the dollar. Strong today, gapped up, higher high. This is not good for stocks, not good for particularly for multinational companies. But after this bounce off the 21, that's a big move up on the dollar over the past 3 sessions. But you can guess how gold, silver, and gold and silver stocks did today. First, gold down 0.8%. Gold stocks, GDX, down a little over 2%. And silver down 2.6%. So silver just about filled that big gap from 2 weeks ago, that gap that came out of the blue and was on big volume, and also, well, big volume for the ETF, and also the follow through breakout above that tight level just completely turned tail the last 4 days, did silver. Let's flip to we'll do Bitcoin first. Bitcoin basically flat on the day, consolidating at this tight level after a big move up the middle of last week, and then promptly giving it all back up over the subsequent 3 days. Let's flip to bonds now. Bond prices weak all day, which means bond yields higher. You can see this is the second gap down in bond prices. Since Thursday, we ran into the declining 50-day moving average. This is the global bond, or the broad bond index, TLT, is the long bond index. Again, second straight gap down, TYX. This move on Friday is why we bought TBT on Friday, as it reclaimed the 21 and the 8, and you can see another gap up here. And yields are coming off of oversold, so they from the stochastic, they could have some room to run. TNX is the 10-year. up, following through on the strength after a sell-off over the prior 2 weeks. That's the inter-asset correlation. Let's get to the tail of the tape. You can pause this. Some news, as I said, Saudi Arabia and Russia extended oil production cuts. Oil popped above $90. Day count 4 up with 3 consolidation days. 6th day above the 80 EMA, 5th above the 21 EMA. We're still expectations still positive as long as the S&P and the Qs hold the 21. That's really going to, as it did today, be dictated by the action of the big 7 stocks, and plus that follow through day we had on 8/29. Sectors, definite bifurcation on those today. XLE energy up. By the end of the day, producers turned red after energy was strong all day. XL, C, K, and Y, those are the tech sectors. C, just barely negative. Software was strong today. Gold, and silver stocks, and basically every other one of the 7 of the big 11 spider sectors were negative. Banks and regional banks down hard. ITB got just absolutely slammed. Transports and retail down week 2. Let's take a look at ITB. So this had a big break 2 weeks ago. This was interest rate related then too, but little by little, it started working its way back, and it had 5 straight up sessions before yields just got the best of it today. Opened weak and just sold off hard over the first 30 minutes before trying to base for the rest of the day. But this is twice now in 2 weeks, or 3 weeks, these stocks just really can't be trusted. We were actually looking at nail to get back in to take advantage of this. If these would have held on a pullback, you don't want to buy after 5 days up, but they didn't hold. And not only didn't it hold, it broke decisively. Tough break here for the home builders. Let's take a look at a couple of the leading charts, and you can see very clearly Toll 4 days up, gave it basically all back in one day. EHI, another big one, down 5%, and you can see the wedge up and then giving it back in one day. So that was a standout, and not in a good way, from the sectors. No changes to the portfolio today. Our beta's adjusted beta at 1.4. Bottom line, big oil and big tech were the lone bright spots as yields in the dollar were higher, and that hit mid and small caps. Just closing back below that 4,500 area. Plenty of support below this level. And again, we don't predict. We have our expectation in place. If that expectation changes, we're positioned based on our expectations. We're not predicting a far away move up. We're not predicting a breakout based on seasonality or the dollar or rates. We take it day by day. We just keep tabs on what's going on in the indexes and leading stocks, and most everything on our leading in GROTECTION held up well today. So let's take a look at Keltner channels on Thinkorswim. So basically what this is a way of seeing how extended, either to the upside or the downside, a particular ticker is relative to the red line, which is its 21-day moving average. So the first ATR, these are called Keltner channels. The blue line is plus or minus 1 ATR. The second line, the green line, is plus or minus 2. The gold line is plus or minus 3, and the blue line is plus or minus 4. We're starting off with Uber here. We're going to go through all of the 21 over 21 list. So here's Uber, and you can see this basing, and then it made its move up, got to plus 2 ATR. That's far enough. In a strong market, the strongest stocks will blast ahead to their plus 3 and their plus 4, and they'll ride it higher. Uber's really not that type of stock, and this is really not that type of market. So this 2-day pullback, very normal for Uber, seeing what happens when it comes back to the 21. After all, that reclaim of the 21 after we got stopped out down here, reclaim of the 21 is what made us get back into it. Next up, NVIDIA. NVIDIA at the +2 ATR poked its head above there last week. That was just a little too far, too fast in this market. Looking backwards, you can see the +3 has pretty much contained the move over the last month and a half or so, and pulling back to the 1 ATR now. Uh, One stock that we own that's not in the 2121, or it wasn't, but it will be the first entry in, and that's Tesla. You can see the big give back on Friday, just came back to the 21 EMA, and we rallied back up to the +1 ATR today. NRGU, this is one that we've added to. We bought this 3 times over the last week. Got close to that +3 ATR today and just pulled back. But you can see when this is really running strong, how look for this period of time here where it came off the 21, got up to the +3, and just rode the +3 higher for almost 3 weeks with one break back below it. This is where we took profits last time on NRGU, and then it started to break below, and we got back in as it came back up through the 21 last week. And TBT, this is our two times interest rates. You can see how this gets all the way up, extended to the +4 ATR at times, and that's uh, really one of the big pluses in looking at these charts. Is it tells you historically uh, how extended something can get to the upside, and then if it gets that extended, how it can continue to act. You see we're not quite even up to the +2 ATR on rates, and that's really not a good thing. So this TBT position is pretty much acting as a hedge. I'm going to blow through the rest of these 17 charts. AAOI hanging around the 21. ANET, ANET +2 ATR and pulling back and trying to hold it after a nice move up on earnings. APP, shouldn't have to click in there every time, but that's what TOS does. APP, you can see how, again, very strong gap up on earnings. This hasn't even broken really the +2 ATR the entire time. It continues to trudge higher after breaking above this 40 support level. Axon, this had a gap up, but just within the base, pulled back to the 21, bounced off the 21, and is attempting to continue higher. Bungie or Bungie, I'm not really sure what it is, but it would help if I hit the right letter there. So between this is you see how tight the Keltner channels are. This thing has a narrow ATR, and its daily range today was between the +2 and the 21 EMA. CCJ, great acting uranium stock, got extended up to the +3, pulled back today almost to the 21s. You can see how this rode the rail of the +2 ATR higher. CEIX, a coal stock. Michael did a great fundamental deep dive into this on a podcast 2 weeks ago, and this has really, really continued to show some serious relative strength. So this is a situation where the fundamentals and the technicals are really lining up, as it had a good day today. Celsius, one of the biggest growth leaders after its earnings gap up, riding between it's topping out between the +3 and the +4 ATR. That's where it got today before pulling back a little bit, but then the market was weak going into the close. Fastly, back on our radar after a nice earnings report, hanging out between the +2 and the +3 ATR. IBKR, Interactive Brokers, just bouncing between the 21 and the +2 ATR. LLY, Lilly, with its weight loss drugs, a true leader, gapped up on earnings and just staying in the upper part of that range very clearly. LNW, Light and Wonder, tough day today, but it had been showing strength before that. Ran into the +3 a couple of weeks ago, and really the +2 was kind of containing most of its run. NVO, the other weight loss ticker, Novo Nordisk, got extended after its earnings report, and biggest pullback was to the +1 ATR on that. Palo Alto, good earnings report last week. Or the week before, gapped up. Didn't show any follow-up strength as it got to that +2 ATR, pulled back to 21, trying to do a U-turn after its earnings report. Splunk, SPLK, another recent addition after its fantastic gap up and just continuing to ride the +4 ATR higher. This is true strength that's being displayed here by Splunk. Any pullback, we'll be looking to enter this. VRT, kind of a similar stock, also extremely strong, riding the +3 ATR after its earnings gap up. And finally, Weatherford, an oil name, oil leader, big reversal when it hit the close to the +4 ATR today. And then pulled back to the +2. So that's some of the things we do intraday that don't show up in MarketSmith, and wanted to take you through that. If you want to see more of those, let me know in the comments. And with that, we're going to wrap it up. Remember, it's not how much you make in the markets, it's how much of that you can keep. Ever vigilant on what the indexes and our leading stocks are doing on a pullback. So stick with us and our videos every night. We'll keep you on the right side of the market. Love to hear from you. First of all, if you're watching us on YouTube, make sure that you like, subscribe, and hey, share any videos that you like. We'd appreciate that. Spread the word about that you don't have to be a slave to the market. Active management can work if you know the technical rules to apply it. My email is don@revereasset.com. My partner, Dan Stewart, if you're interested in becoming a client, is dan@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. And with that, we're going to wrap up the video for Tuesday, September 5th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.